$190 million. That's what Mark Zuckerberg agreed to pay on November 20th, 2025. Cambridge Analytica. Privacy violations. 7 years of litigation. And here's the part that broke Wall Street's brain. Meta's stock rose 11.5% after the announcement. Shareholders demanded $8 billion. They got 97.6% less and celebrated. This isn't a loss. It's a masterclass in settlement economics. And I have the court documents to prove it. 2016, Donald Trump's presidential campaign. Cambridge Analytica harvested data from 87 million Facebook users without consent. 2018, the scandal breaks. Congressional hearings. FTC investigation. 2019, Facebook pays $5 billion to the FTC, the largest fine in FTC history. But that wasn't the end. Shareholders sued Zuckerberg and Meta's board. Their claim? Directors knew about privacy violations, did nothing, and then overpaid the FTC settlement to protect Zuckerberg personally. Delaware Chancery Court, April 25th, 2018. Karen Sbriglio files the first derivative complaint. Derivative lawsuits are special. The company is the injured party, not individual shareholders. If she wins, Meta recovers the money, not individual investors. More shareholders join. Mark Andreessen, Peter Thiel, Sheryl Sandberg, all named as defendants. The claim consolidates. 7 years of discovery. Thousands of internal documents. A deposition scheduled. And then July 17th, 2025. First day of trial. Zuckerberg was scheduled to testify the next morning. Hours before taking the stand, both sides reach a deal. Here's the official court filing. November 20th, 2025. Mark Zuckerberg and other Meta Platforms Inc. directors agreed to a $190 million settlement of claims they failed to rectify repeated violations of Facebook users' privacy. Quote continues. Shareholders sought at least $7 billion in damages. Let that sink in. $7 billion demanded. $190 million paid. That's a 97.3% discount. But the settlement was sealed since July. Why reveal it now? Trial halted July 17th. Settlement announced November 20th. 4 months sealed. During those 4 months, Meta's stock climbed from $607 to $673. A 10% gain while hiding a $190 million settlement. If this kind of financial detective work is new to you, you're in the right place. We expose these patterns every week, but hit subscribe. Because the timing of disclosure, that's strategy number 1. And there are 3 more strategies I haven't told you yet. Judge Kathleen McCormick oversees the case. The same judge who rejected Elon Musk's $55 billion pay package. Meta shareholders' attorneys argue that the $5 billion FTC settlement was engineered to protect Zuckerberg. The FTC wanted Zuckerberg personally fined. The board negotiated a corporate-only fine instead. Company pays. Zuckerberg pays $0. Stop. Before I show you who actually paid this $190 million, you need to understand what shareholders were really trying to prove. The derivative lawsuit claimed Meta's board breached fiduciary duties. Fiduciary duty means directors must act in the company's best interest, not their own. Shareholders alleged directors knew about repeated privacy violations dating back to a 2012 FTC consent order. They did nothing to fix it. Then, when the 2018 scandal hit, they allegedly structured the $5 billion FTC deal to shield Zuckerberg from personal liability. If true, that's breach of fiduciary duty. And the penalty? Personal liability for directors. Personal liability. That's the nuclear option in corporate law. If shareholders won, Zuckerberg, Andreessen, Thiel, Sandberg, they'd pay billions from their personal wealth, not Meta's money. Their money. And here's where this affects you. If you own stock in any company where the CEO has majority voting control, you're one scandal away from the same playbook. The board protects the founder, not you. Quick question. Do you own stock in a founder-controlled company? Type yes or no below, because what I'm about to show you reveals the real cost of that structure. Here's the system. Meta's board has directors and officers insurance, D&O insurance. It's designed to cover legal fees and settlements when directors get sued. Meta's D&O policy is reportedly worth hundreds of millions. The $190 million settlement paid entirely by the insurance company. Zuckerberg's net worth? $180 billion. Amount he personally paid? Zero. And critics said shareholder lawsuits would make billionaires accountable. This proves it's just insurance arbitrage. Send this to anyone who still believes derivative suits work. Let's calculate the settlement economics. Shareholders sued for $7 billion minimum. Meta's board fought for 7 years. Legal fees? Estimated $50 to $100 million. Trial was set for weeks, maybe months. More legal fees piling up. Then hours before Zuckerberg's testimony, they settled for $190 million. Insurance covers it all. From Meta's perspective, this settlement cost the company zero. From Zuckerberg's perspective, he avoided testifying under oath. From the insurance company's perspective, they paid to avoid a potential $7 billion verdict. Here's the settlement timeline strategy. Agree to settle in July, seal the amount, let the stock climb for 4 months, then disclose in late November, right before Thanksgiving holiday. Low trading volume, minimal media attention. Stock barely reacts because investors already priced in a settlement. Wait, I know what you're thinking. If the settlement was sealed, how did investors know to price it in? Let me show you why that question reveals the insider information problem that makes founder-controlled companies dangerous for retail investors. Here's Meta's third quarter 2025 earnings report. Revenue, $51.24 billion. That's 1 quarter. Multiply by 4, roughly $205 billion annual revenue. Now divide 190 million by 205 billion. 0.09%. The settlement represents less than 0.1% of Meta's annual revenue. At Meta's current profit rate, they earn $190 million in under 4 hours. Remember that $7 billion original claim? That would have been 3.4% of annual revenue. Still pocket change. This is why I audit tech warfare economics. Subscribe if you want to see what else they're hiding behind insurance policies. November 20th, 2025, settlement disclosed. Meta's stock opens at $673. By end of day, it's at $680, a 1% gain. Bloomberg reported a buy signal was issued from a pivot bottom point on Thursday, November 20th, 2025. And so far it has risen 11.54%. Stock rises after bad news. That's not normal. That's a signal. But we're not done. Because behind every settlement dollar is a governance change that affects every shareholder. 87 million Facebook users, their data harvested without consent. Cambridge Analytica used it to target voters. 2016 election, Brexit referendum, psychological profiling, micro-targeting. Many users never knew their data was compromised. The FTC investigated, $5 billion fine, the largest in FTC history. But did it change anything? Meta's privacy violations continued. 2019 consent order required privacy audits. Meta missed deadlines, violations documented. And the board? They knew. Internal documents show repeated warnings ignored. Karen's Briglio, the shareholder who filed the first lawsuit. Not a billionaire. Not an institutional investor. A retail shareholder. She sued on behalf of the company, seeking to recover losses from director misconduct. 7 years she fought. But the settlement doesn't show the board meetings where privacy warnings were dismissed. The internal emails marked attorney-client privilege. The strategy sessions on how to minimize Zuckerberg's liability. They don't teach this in business school. Now you know what institutional investors have known for years. Have you or someone you know lost money in a founder-controlled stock? Share your experience below. 2016, Cambridge Analytica scandal. Data harvested for political targeting. 2025, Meta trains AI on user posts and images. No opt-out for existing content. European regulators, object. Meta pauses AI training in Europe. Continues in the US, same data, different purpose, same lack of consent. But here's the question investors should be asking. And I saved the most disturbing evidence for last. Because this settlement included governance changes. Changes that tell you exactly what Meta's board admits they got wrong and what they're still not fixing. Delaware Chancery Court, 2025. Same courtroom where Judge McCormick rejected Musk's pay package. Different case, same pattern. Founders with super voting shares. Boards that protect founders over shareholders. Compensation and settlements structured to minimize personal liability. Menlo Park, California. December 2025. Meta's headquarters. Same building, different AI strategy. But look at the governance structure. Zuckerberg still controls 57% of voting power, with 13% economic ownership. One shareholder, one vote? Not at Meta. Check your portfolio's voting rights structure. The same control pattern is hiding in Tesla, Google's Alphabet Snap. Send this to anyone who thinks shareholder democracy exists in tech. Here's what Meta agreed to as part of the settlement. Quote, "The company's board has agreed to strengthen policies on director conduct, insider trading, and whistleblower protections." End quote. Implementation deadline. 90 business days after settlement becomes effective. Remember the $5 billion FTC fine we discussed. Remember the $190 million insurance payment. Now look at what they're finally implementing. Whistleblower protections. 7 years after Cambridge Analytica. You will live through the next privacy scandal. The question is whether you see the settlement pattern coming. This is happening now in real time. Subscribe to understand the economics before the next Meta lawsuit drops, because there will be a next one. Here's the economic summary. Meta's board paid $0. Insurance paid $190 million. Shareholders demanded $7 billion. Got 97% less, and the stock rose 11%. Why? Because the market price is in risk. A $7 billion verdict would have crashed the stock. A $190 million insurance payout is noise. Here's my controversial take. Derivative lawsuits don't work. They're settlement theater. Insurance companies pay. Boards learn nothing. Shareholders get press releases about governance improvements. Tell me I'm wrong in the comments. You can't unknow this. Every Meta privacy headline, every tech settlement announcement, you'll recognize the insurance arbitrage pattern. What will you do with this information? The next video I'm making investigates TSMC versus Intel. $10 billion in trade secrets at stake. What topic should I investigate after that? Most interesting suggestion gets the next deep dive. Meta's $190 million settlement is a blueprint. Insurance pays. Founders protected. Shareholders get governance theater. Stock rises because the real cost was $0. If you want to understand how tech lawsuits move markets and affect your portfolio returns, this is the only channel that breaks down the insurance economics and settlement strategies. Subscribe and hit the bell icon. I expose what business media won't touch. Every single week, click here for the TSMC versus Intel trade secrets war, $10 billion at stake, or this one if you missed the Qualcomm victory over ARM. See you there.